BHP Billiton, the world's biggest mining company, reported first-half earnings that beat analyst estimates. These earnings highlight quite a dramatic reversal of fortune over the past year for this sector. Joining us now, I'm very pleased to say, the CEO of the world's largest mining company, BHP Billiton, and of course his name, Andrew Mackenzie. Andrew, great to have you with us on the programme. We've outlined a buoyant commodity market, a stock price of yours last year that absolutely surged, and then your earnings come out this morning. It's a focus on debt reduction. It's a cautious tone about what's happening in commodities, full stop. What underpins the cautiousness for you, Andrew?
Well, I mean, first of all, although I'm very pleased with the earnings, I think you can overemphasize some of the things that are happening on the commodity markets. We've been working towards this kind of outcome for 3 or 4 years. We've steadily been driving more and more productivity. Our costs are down by almost a half in those 4 years. And finally, with a pause in the falling commodity prices and in some cases slight rises, we're able to see a whole new amount of cash coming through to the bottom line. I'm particularly pleased with our free cash flow number of $6 billion, almost $6 billion, after we've invested in a lot of growth projects. And that's meant we've been able, as you say, to drive our debt levels down, so our gearing is now 24%, and also reward our shareholders with a dividend ratio, which is a payout ratio of 66%. We committed to 50%, so that's an extra $500 million of cash for shareholders. The caution really is based on the fact that, yes, some prices are now a little higher than we would have expected them to be around now, particularly iron ore and coal, and longer than we would see them being in the long term, although we're obviously heavily invested in things like petroleum and copper, where we see some of the price risks to the upside. The other caution is it's a very uncertain world out there. I've just been listening to the previous part of your programme. You know, we're not quite sure where the Trump administration is going to settle down and what that might mean for world economic growth. But we are slightly alarmed by a lot of the sentiment around protectionism, because ultimately that is going to have a bad impact on world trade. And we're a business, commodities, which flourishes when the world economy grows, and the world economy grows when world trade is growing. And I don't think there's any ifs or buts about that.
Well, Andrew, a lot of things to pick out from that, but traditionally, over 10 years ago, the story was to boost volume as prices pushed higher. The story now, it feels for you guys, is to take the extra cash and to do things like get your debt down. So for me, the question is, are you going to continue to look at things like debt reduction over, say, investment in more volume?
Well, we have a very strict capital allocation framework that distributes our cash between adding more volume, between, as I say, securing our balance sheet and giving cash returns to shareholders. But we don't grow this company per se by growing volume. We grow it by growing value. And we grow our value really in 2 ways. We make what we've got a lot more productive. In some cases, that can mean more volume, but in other cases, it can mean the same volume for a lot less cost, and we've done a fair bit about that. And then we add more productive units. And one of the great things about the work that we've done over the last 2 to 3 years is we had a bunch of projects that were probably marginal at best. We've now turned them into highly investable projects that will allow us to invest quite significantly, particularly in growing our oil and copper businesses in the next few years.
Yeah, and Andrew, I want to highlight 2 metals that you have deep exposure to, and that's copper and iron ore, and they have a very different story. On the one hand, iron ore prices, even you yourself are skeptical about a rally. Analysts think we're going to see lower prices. So how do you protect your cash flow? How do you hedge that?
Well, we don't hedge it. The way that we protect our cash flow is we protect our margin. We already have driven our iron ore production costs quite low, but we believe we can drive them quite a bit lower with some of the things we have underway. And so that's the best way that we can protect that. But at the same time, our productivity agenda in iron ore will both reduce our unit costs, but it will also increase volumes. And so in that way, even though prices are falling, we can look after our gross margin.
Gotcha. So volumes there over the price. For copper, it's very different. Citi out with a note yesterday saying that they see $8,000 a ton or more before the end of the decade for copper. Do you see that kind of massive rally and the deficit that Citi does?
Well, maybe not as quick as the end of the decade, but certainly into the next decade. When we look forward, the growth in demand for copper it exceeds what we see as the new supply that will come on to match that certainly by 2020. And copper is one of those metals that even if China is moving into more of a consumption phase, it'll want to use more electricity, and most of that electricity will at some time go down a copper wire. And that's why in our investment program going forward, it's much more biased to adding copper production than it is to iron ore production.
Andrew, let's talk crude. Brent at 57, WTI 54.44. Your shale assets, is now a good time to sell?
I don't believe so, because I think the price could go higher. I also feel that with our shale business that we're working very hard at continuing to drive down our costs. And by driving down our costs at the same time as we see the price rising, we're getting ready, probably. We're doing some experiments. We're fracking our uncompleted wells. It used to be known as, or still are known as, ducks. And I think we will start to put more rigs back as the price improves and as the costs go down. I don't think we would get that kind of value if we were to rush to a sale right now, at least for our core assets, which we value very highly. But we also have a number of offshore or conventional petroleum investments underway with BP and Chevron. We're investing in a big project in the Gulf. And we of course won the competition to be the first foreign company back into Mexico to develop a field there. And in a week's time, I will be going to Mexico to sign that deal, and that's another investment that we will make to grow our oil production.
Well, here's what interests me, Andrew. You could have been any CEO involved with the oil market, and then you would have told me, we're going to put rigs back to work. So put that together and reconcile the idea of putting more rigs to work, but you also think crude's going to go higher. What's going to underpin the price growth of oil in the coming year if a lot of CEOs like yourself are looking to put rigs back to work?
Well, I think two things. I think the OPEC cuts are probably as large, if not larger, than promised. And we've seen a larger growth in the demand for crude than we would have expected a year ago. So we've got two signals that are perhaps slightly more on the bullish side for price, and one, to your point, that is slightly on the more bearish side. But I think the volumes of oil that will come simply within the US for companies like us putting a few more rigs into and some of our rigs, by the way, are put to work on gas, not oil, but into the Blackhawk or into the Permian, are not that large compared to some of the things that are going on in terms of increased demand and some of the OPEC cuts.
And let's wrap it up here talking about copper. You mentioned that you have a bias toward copper over iron ore, but you have a copper problem, and that's in Chile, the Escondida mine. You're now at day 13 in terms of work stoppage there. The other two strikes you had were 14 and 30 days. What makes this strike different than the others?
Well, every strike is different. I don't know how long this will go on, but I'm determined to continue along the track that we have of making our assets more productive. That makes them more competitive. They earn more investment. They guarantee more employment going forward. And I want us to reach an arrangement with the workforce that provides a degree of flexible working, a commitment to productivity. This is a very well-paid workforce. And in everything we're trying to drive them, they will still remain well-paid and very much part of the higher-paid workforce in Chile. But we want to do that in a way that can guarantee that for a long time.
Right, and like you said,
people who will be in that workforce for a short period of time and those who will be there for a long time. And
like you said, the productivity in some ways gives you leverage over the workers. What's the deficit going to be? I mean, Goldman Sachs said that a 20-day stoppage could pull out 64,000 tons of copper from the market. Do you agree with that kind of assessment, and can you offset it with your other mines? We run all our operations pretty much flat out to high productivity, so we can't really offset that from our other mines. I don't know what the actual deficit will be, and that's better to come up with an estimate once we've actually settled this strike. But the copper hasn't gone away. It's still in the ground. It will get produced, but it may not all get produced this year because of that strike.